The red-hot American economy, gripped with soaring inflation and rising interest rates, hit today with what CNBC's Rick Santelli called a nasty report with some serious surprises. According to the Commerce Department, America's economy shrank for the first time in nearly 2 years. Gross domestic product is the broadest measure of economic activity. It declined at an annual rate of 1.4% in the first quarter of the year. It's the first negative quarter since spring of 2020, right at the start of the pandemic. It's also a sharp reversal from the 6.9% annual growth rate in the final quarter of last year. Wall Street really shrugged off the disappointing economic news. All the major indices closed solidly in the green. Dow, S&P, NASDAQ had their best day in more than a month. The White House seemed unfazed as well. Today, President Biden said he's not worried about a recession, at least not this year.
No one is predicting a recession now. Some are predicting there may be a recession in 2023.
Well, President Biden insists the economy is still headed towards the right direction. CNBC's senior economics correspondent Steve Leisman's with us. You know, few seemed overly worried about this number. Why is that, Steve?
Yes, Shep, this was a false alarm. All the things you care about in the economy that showed up in this report did well and added to growth. Even the number that subtracted from growth, I'll get to that in a second, told you the economy remains healthy. Now, let me explain. Consumer spending grew by 2.7% in the quarter. That's after inflation, so it's a solid number. Business investment rose by 9.2%. Also after inflation, and that's a terrific number. It tells you businesses are investing in new machinery for the future. Okay, so business and consumer spending did well. How did we go negative? We imported boatloads, plane loads, and railroads of stuff from abroad. Trade peeled a whopping, get this, 3.2% off of the GDP number there. So that's to say, if you take out this massive trade subtraction and we have this oscillating back and forth because of opening and closing of ports with the pandemic, the number would have been solidly positive. In fact, these imports are probably a sign that the economy is doing well because we need overseas production to meet demand. Now, everyone is worried about that recession because of inflation and higher interest rates coming from the Fed. That may happen later this year or next. No one knows for sure. I'm fairly sure this was not the beginning of it. Most forecasters look at these numbers and they say, hey, we're pretty confident the next report's going to be on the positive side.
All right. Does this change anything for the Fed and how it's fighting high inflation?
Not quite the opposite. The Fed is going to look under the hood of these numbers just like we did, and it's going to confirm and affirm their need to raise interest rates to cool the economy. The inflation numbers we got with this report were pretty fulsome, up above 7%, and all those imports will probably turn into sales down the road. So the expectation is the consumer still has the means to pay higher prices and then some for a while here. I think that may not be true later this year. I think the savings from the pandemic start to wind down, and consumers could find it difficult both to keep up with inflation and spend more. But that's what they're doing right now, incredibly, so far, Shep.